Yeah, because I mean, there's $14 trillion in home equity. There's 35 trillion in home equity for all ages, 14 trillion just for people over the age of 62. And so why is it an unmanaged asset? I mean, everybody's in the financial planning world is going after a 401k rollover, sell an annuity, whatever, which is all great stuff. But what are they doing with the other half of the equity, which is in the house? What are they doing to manage that? Because that's an asset. And it's the largest unmanaged asset in the history of any country in the world. Sooner or later, that's where I'm telling you about the gradually then suddenly. There are things happening right now that's going to change that, and it's not going to change it a little bit at a time. It's going to be a dramatic shift. And when the financial planning community really understands that, we'll forget all about those years of decline, and all of a sudden it's going to be crazy, and it's going to be a normal thing that's just what you do. You do a reverse mortgage as soon as you turn 62. If you're older than 62, you're going to do it anyway, and that's just one of the things that you're going to do to fit in as part of the plan. And is that a year away? It may be. Is it more likely maybe 3 to 5 years away? Maybe, but it's not more than 5 to 10 years away. And because there's a mass that has to deal with that 14 trillion.
That's right. They have no choice.
Right. And everybody says, follow the money. Well, let's not, when these stats go out, there are big companies outside of the mortgage industry that are looking at this $14 trillion and knowing that's part of the solution.
And to be fair, before we go on to the purchased reverse mortgage, the HECM for purchase, which I should be literally changing the entire senior real estate world and has not. And again, I blame the industry for that. But before we get to that brass tacks, because of higher interest rates, we're lending people a lot less than we ever have. I mean, basically, if you're in your mid to upper 60s, even low 70s, after costs, we're basically lending people a third of what the house is worth. And I've had many financial planners come back to me and go, Michael, we want to do it, but it's so hard to tie up $1 million asset for $300,000. And then because my people planned well and they don't have a mortgage, you're telling me I can't have the $300,000 to do something wise with? I can have 60% this year and 40% next year. I think the future of our world, and I know a lot of people agree with this, I want to get your opinion, is proprietary products. Because if the government doesn't rejuvenate the HECM into the needs of today's greater generations, senior generations, the guidelines of today's HECM does not invite the financial planning community. The proprietary products do, which is why we're seeing their volume increase so much. But lending people 30 to 33% of what their house is worth when they're wealthy and they can walk into their bank and get an 80% credit line. And yes, that comes with a payment, but if they have a good credit score, we're not credit score driven. That's a double-edged sword. But with a good credit score, I have friends going in with their $1 million house, borrowing $750,000, at prime minus a half. Well, why don't you do a reverse mortgage? Well, the bank is giving me $750, Mike. What are you giving me? $300. So we need changes to the HECM. I don't think NRMLA is powerful enough to make those changes happen. So we need more proprietary products. I want to get your opinion about that, where people can say, yes, I want to take out $300,000 and fund a single premium life insurance policy that's going to be worth $2 million when I'm in my 80s, or a long-term care policy. What's your thoughts on that?
Are you done whining?
No, maybe I'm not, but for you, I am.
Okay. Well, I don't disagree that there should be some changes in the program, and I think that it's too conservative right now because of the way that things were set up with the guidelines and the actuarials. So do I think that it should be closer to 40% instead of 30%? Yes. However, hoping for something different I wish that this car would be faster. I wish that this car would be cheaper. I wish that this car would be red instead of blue, doesn't really make sense. And we shouldn't really be thinking in those terms, because the issue is what do we have to sell right now?
That's
Because
true.
if this is what we've got to sell, it's either good or it's bad. And the number of financial planners that whine about the 30%, okay, great. Tell your client to go out and get an 80% loan to value with a payment that is not guaranteed, that is going to double the payment in 10 years or sometimes 5 years, and can be taken away as soon as there's a downturn in the market and froze or asked to be repaid. That is a whole different deal. So if I can get 30%, and let's not forget that 50% of people, roughly 35 million people, have a zero balance on their $1 million house or $500,000 house because it's paid off. So if you can at least get at 30% of it, that's better than zero. And half the people in the United States are still at zero after they're age 62. And then you talk about the other ones, and those other people are sitting on a situation where they're still making a mortgage payment, and their mortgage is only $150,000, and they've got a $500,000 house. Shame on the financial advisor for complaining about the loan to value. They
That's right.
should be
No,
immediately refinancing and taking it to zero. So is it a good idea to look at the proprietary products? Yes, but the proprietary products, because they're not insured, have a much higher interest rate, so you lose equity at a faster clip. Yeah, your initial closing costs are higher. We definitely use them, and there is no question that I'm glad they are there. I am glad that the proprietary products are there and that they're growing and that there's more options available, and I think that's going to continue. Do I still think there should be changes in the government program? Yes, but in the forward world, there's a VA, there's FHA, there's rental loans, there's non-QM, there's all kinds of different scenarios. We just don't have as many options, but we sell what we have. And if what we have is good enough, it's not perfect, but if it's good enough, that is enough. It was enough for me to eliminate my mortgage payment of $3,500 a month. And eliminating that $3,500 a month, that was awesome, because I eliminated that $3,500 a month, sent it to my advisor, and my net worth in 4 years went up by $200,000 after I subtract the closing costs and after I subtract the accrued interest. That's a great deal, and that's under very restrictive guidelines on the mortgage side.